listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. With me is a returning guest. He's Vince Lancy. You all know who he is, so no need for an intro, although he does write the Gold Fix, and he's been involved in the futures market for decades, so he knows what's going on as well as anyone, in my opinion. Vince, look at what's happened in the market in the last couple of weeks. I mean, me personally, I was looking at gold thinking, even just 2 or 3 weeks ago, I was thinking, is this going to drop below 1,800? You know, the miners aren't that strong. Silver doesn't look good. Are these things going to retest the lows? And suddenly we have some bank failures. Now the market is discounting tons of rate cuts before the end of the year. Gold with the huge close above 1950 today. What are you thinking about today's action? I mean, what are your initial reactions?
Well, I think there's several things we could talk about, but you touched on one of the problems that I have. You started out by saying, I was thinking it would go down or have a retest or a retracement, and then the banking crisis. Go back 2 years. We would be thinking that would happen, and sideways meant down. The longer we went sideways without any big news, and there was rarely big news that would move gold, the more likely the banks and the longs would get nervous and start to sell, and the banks would lean on it. Well, frankly, without getting too quanty about it, since Basel III and since everything that's happened with the inflation, there are people who sell gold, but they're not natural sellers. I don't see producers selling. I don't see big short side players getting in. I don't see it getting overbought that much, and sideways is bullish. It's crazy, right? I mean, Jeff Gundlach said today, he's like, I got bullish in gold around 1,800 when it traded sideways for a long period of time and it didn't drop. That's almost a quote. And I read that today, and you just said that. I was like, yeah, when it trades sideways and doesn't get beat down, we're just waiting for it to get beat down. So that's my own bias. I mean, I wasn't long. I was long for 2 months and did well, but I missed the first run up to 1950, and then it came off, and I got long, and I got out really quickly again. It's like I keep, because of my own scar tissue, I guess, I keep, when I'm not trading technically, when I'm not trading tight, I keep taking profits short. I always, I risk 1 to make 2, but I'm not risking 10 to make 20, So that's what's going on. But to answer your question about today, today's an example of something I think that's significant. Now, I'm not a technician, but I want to tell you a story that happened yesterday. I work with Michael Moore, and Michael is a technician. He uses several different systems, and I've worked with him for years, but he's not a stock guy. He just does commodities, and gold's one of the commodities he does. And we talk, aside from me, using his stuff, and Gold Fix people getting access to it as well. We talk outside the box. And so that's the setup. Yesterday, I pulled up one of my gold charts, and I had an alert that was months old, that if it trades 1970, it needs to beep, right? And I saw this yesterday, and I said, what the hell is that doing there? Like, I'd forgotten about it. And so, I just ignored it. And then the market went up to 1860 today, and I went, all right, wait, 1960, and I go, wait a minute, let me see what's going on. So I looked up my data templates and my notebooks, and I had a conversation with him 6 months ago, and he said, because we thought we were going to have another breakout, he said, if it gets, we were trading higher. We were trading, no, not higher, not 6 months ago. 3 months ago. He goes, if we get above 1970, this is pure technical comments, so you're going to be able to weigh in on this and say yay or nay. He said he was looking at daily and weekly charts, and he said, if we get above 1970, you are bullish. If we go above 1970 and go back into it, you are neutral. If we go below 1944, you are bearish. And that was what he had. And so sure enough, it triggered 1970 today. And I started looking for things to do, and I didn't do anything, even though we had a big run up. I did put a trade on today. I'll discuss with you because I'd like to get a technician's handle on it. I put it on for different reasons. But what I'm getting at is the gold market. If you look at the chart, when the daily chart, we started traveling up in a diagonal, 30 to 45 degrees. And then we had this whip higher to 1950, this drop lower to 1800. And then we went right back to that 45-degree line again, 30, 45-degree line. So speaking technically, I have rarely, if ever, seen on a daily chart gold establish a trend, overperform, reject, underperform, and then reject. We never reject after we underperform. We underperform and we just bounce around at the bottom, like 1800. But we didn't. We came right back up. And now we've returned to trend. And I'm not even looking at those cup and handle things that people look at. But I think if you're looking at a cup and handle thing, this is not my thing. But 2 or 3 different guys that I just look at, I don't really pay much attention, said if we closed a month above 1940, it's really going to be off to the races. So I'm asking you, I'm telling you this, behaviorally, I'm not getting outrageously bullish. I put a trade on today. I bought gold and sold a 20-year bond, which sounds like suicide when you think about it. We can talk about that too. I'll get your opinion on the chart on that. But I didn't want to buy gold naked. But as a short term, because I wanted to put a long-term trade on, as a short-term trade, you got to be a buyer above 1970. Because if we hit 2000, it's going to be sold hard. But if we hit 2000 and it gets through that after that selling, you're going to have this US-based boomer, inflation, bank closure fear that's going to come in. And I got to tell you, with what's going on with the banks and the Fed, in the past, 10 years ago, gold would have done well, but not that well. But now it's doing well because we're not the only ones buying it. Europe's buying it, Asia's buying it. And the only seller left is Russia. If we go up to a certain price, Russia will probably dump a lot of it. Anyway, so that's where I saw it. So that's my initial reaction is above 1970, long, below 1970, flat, below 1945, short. And that's how I'm playing it. I'm long now on a spread.
And so you're talking, what's your time frame? The next, week or the next couple weeks?
Oh, well, okay. That trade, it's not a naked long trade. That trade I put on, I want to just be long now. I want to be naked long, but I'm not speculatively naked long. I'm long, right? Because I own it, but I'm not speculatively naked long right now. So what I'll do is I'll put on something that's a spread. And what I did was I bought gold and sold TLT. GLD and TLT has a spread. That's what I did. And I'll tell you what I did there. GLD versus TLT, whether you do it as a division or as a subtraction, as it goes up, that's a sign of inflation. As it goes down, that's a sign of deflation. Very simple, right? So if you pull a chart up, you'll find out that on a daily chart, you'll see that when inflation started in 21, it starts to ramp higher. And then mid-year in 22, it has a pretty solid dip. And that's gold getting hammered as bonds are rallying because they think the inflation is going to back off. And now we're raising rates. And this is kind of a paradox. We're raising rates. Inflation is truly, at least for now, coming under control. But that thing just made new highs. And so I bought new highs in that relationship because I think that if inflation kicks in again, it's going to rip higher. So back to your question, that is a 2 month to 2 year trade, which doesn't help your shorter term people. I trade short term. I'll get a couple days of that under my belt, and then I'll start stepping in actively trading it. Like I'll be a buyer above 1970 for 1 day to 1 week, a seller below 1940, that type of thing. But right now, right now, I think the market is, everyone's going to have an opinion, right? So I'll tell you something that's probably going to be, I think it's going to be very helpful to your listeners. If you were to do a regression analysis of gold performance since forever, since post 1990, gold never, strong word, but I'll say it, gold almost never is higher 2 weeks after it has a 2% rally in 1 day. So if gold pops 2% for whatever reason, 2 weeks later it's lower because there's a cap on gold. There has been a cap on gold for years. And I was told this by a gold trader who had ties to the Fed. And basically it's like this. When it goes 2% higher, they're worried about it getting in headlines. If they're worried about getting in headlines, they'll do what they can to smash it down a little bit. But, well, this year, when gold hit those lows and had that massive 4% move off the lows, I think it was like 4%. It was like unbelievable. Like almost $250 days or something like that. I went, that doesn't make sense. In 2 weeks, we're going to be lower. And we weren't. There was no smash down. We didn't go lower. And I said, whoa, that's not like gold. The banks are letting it breathe. Fine, the banks are letting it breathe. It'll happen next time. And then like last week, we had a 2% rally. And then this week we had a 2% rally. And then we have today. And I went, wait a minute. And this is what's going on. I've seen this in the past, and this is what I hope is helpful to your listeners. The Western governments, not the Western, the United States Federal Reserve and the United States Treasury do not want gold taking headlines that shows competition with the dollar. And when there's no crisis going on, they are on top of that. You know, like what, white on rice, whatever you want to call it. And they hammer it down or keep a lid on the rally. They'll let it rally, but it has to be orderly. But these last 2 months and this last week, they're not looking at gold at all. They have limited bandwidth. They're preoccupied with the banks, and they'll deal with gold when this is settled. So while I do believe we have a big sell-off in the works as a pushback, I do not think it's going to sell off and keep going, because the bullion banks, in my opinion, are no longer short sellers. Now, everything I just said to you, what I'm basically saying is and everyone, oh, we've heard this before, last time I was up here, you never heard it from me, you know, and I'm just saying that, you know, until they get a handle on the bank defaults, and it's not the bank defaults, the inflation, and it's not the inflation, it's the perception that if banks can go under, people are going to say bank runs, and they're just going to throw in the towel one day and say, I give up, just put some money in gold. And that's what's going to happen. So what I'm saying is, technical analysis aside, this market has been percolating for the last year, the last 6 months. And I think that it's going to become a buy the dip market, especially with all the fundamentals and secular changes going on right now. But right now, I'm long because I own it, and I'm long in a spread that's heavily betting on inflation, which is not going to happen tomorrow. I also believe, I'll throw this one thing at you. The higher we raise short-term rates, the steeper the called backwardation in the yield curve goes, the inversion goes, the worse it is going to be later when the rates come down. They have to let the 30-year bond rates go up, which to me says they have to let gold go up. So that's why I'm bullish for a longer period of time. So what do you think?
Yeah, I mean, let's talk about at least my thinking on macro fundamentals, and then we can get to technicals again. Because I think for me, the I mean, I am a technical guy, but I'm constantly thinking about macro fundamentals because as a technical analyst, gold, it can be a mind fuck so many times. I mean, you can look at the chart and say, oh, there's a double top. There's this. I mean, I could give you why it's bearish, why it's bull. I mean, and it's you. I mean, you trade it. It's much different from other markets. So I look at the macro fundamentals. I mean, to me, we see gold against foreign currencies. Another way of looking at that is gold multiplied by the US dollar index. Today closed at a fresh new all-time high. Gold against the S&P 500. It looks like by a hair that broke out today. Certainly the weekly close is a 2-year closing high. So we're seeing gold gain in real terms, which is a precursor to the dollar price going up. But for me, fundamentally, and I'm not taking a victory lap because I tweeted something, I don't know if it was 6 months ago. I think I bumped it a couple of days ago, but I was thinking like a year ago, gold breaking above 2,100. I mean, this is going to be the most significant breakout for gold in 50 years since they let it go in 1970. I mean, looking at the chart, breaking out of the cup and handle, 13-year base or 12-year base, whatever it is. And so there has to, for that to happen. I mean, I know that people say, oh, well, markets just move and the reason comes later, but there has to be some reason for that to happen. And for me, I even back then I was thinking we are going to see an easing, you know, whether it's cutting rates or the Fed's giving people money or it's huge fiscal stimulus, we will probably see an easing of policy when inflation is not all the way back down at 2 or 3%. And that's basically a signal that, like you're saying, the people who watch the market, they're just going to have to say, well, shit, we're just going to have to let it go now. There's nothing we can do. We have to support the banks. You know, we can't let a real, you know, the word collapse gets overused, but we can't let another 2008 type of collapse happen. And I think, and so gold is even, you know, it's even, I mean, it's like you're saying, people are just, it doesn't even have, these things don't even have to happen for them to, I mean, they're sniffing it out. People are, I mean, they're seeing what's happening and they're just, okay, oh shit, you know, bank failures. I got to put my money in gold. Okay, technically it's looking better. And so to me, I just think that we're at the beginning of such an important point or realization that yes, we're probably going into a recession, or I mean, it already has been a recession for 90% of the population, like you're saying. But I mean, I guess I forgot my train of thought on that. But we are entering that point where we are going to have to see an easing of policy because there's a recession, you know, because there's banking problems again, while at the same time inflation is 6%, and it's coming down like you're saying, but we know it's not going to go down to 2 or 3%. All these huge, you can't get it down to 2%. These huge COVID increases that we've seen during that, like they're not getting reversed at all. So it's, I mean, that's the I mean, the damage has already been done. So I think, and gold moves before inflation, as you know. So I just think we're at that point where we're just going to have to see an easing of policy, and inflation is what, at still 5 or 6% right now. Yes, it's going to come down a little bit more, but it's, you know, 2 years from now, it's going to be headed back up and it's going to be another serious problem.
Exactly. We're in the mid 70s, if that. Well, I want to add something to your comment that you said a couple of times about they're going to have to ease. And this is something I learned today, or I learned yesterday, but I drilled down on it today, and it's going to corroborate. It's like you and I could sit here till we're blue in the face and say they're going to have to ease. Let's pretend that we're not even saying that. Let's pretend that they just can't keep raising. All right, here's why that's true. This is why it's true. I'm going to give you the real reason why it's true. Because you have these banks out there. It's not about inflation. We can't keep raising rates because of the bank defaults. As we raise rates 25 basis points, basically what you have is like, you have people out there that refinance their homes at 2% and now have 5% money markets. These banks are loaning at 2% and borrowing at 5%. So every time the Fed raises 25 basis points, it chops banks down. The next 25 basis points, it's going to keep chopping banks down. And so what's going to happen is if they keep raising rates, you're going to take off another layer. So they have to stop raising. Maybe there's another 25 basis points in there, but they have to stop raising because, and this is what you're saying. If they keep raising short-term rates, they will blow out half of the country's economy. And what do I mean by that? Over 80% of the commercial real estate market is handled by regional banks because it's all local bank working with local businessman, local developer, putting stuff up. 80%. I mean, there's a chart of that. And I talked to a guy in the business. He said it's actually more than that. And I said, why? He said, because there's other things, like everything gets tied to the real estate value and there's other things like that. Anyway, the point is, if they keep, to put it in like a nutshell, if they keep raising rates 25 basis points, even 25 basis points, more banks will go under, more real estate will collapse. If they lower interest rates, inflation gets reignited. Now, without getting, I can really get into this, but I don't want to go down a rabbit hole with you today. If they keep raising rates, banks are going to go under and they're going to have to be giving more and more fiscal money. They're going to have to be bailouts fiscally, right? And if they lower rates, then money comes in monetarily and it goes into stocks. So as they keep raising rates, you're going to have a paradox. As they raise rates to fight inflation, gold will go up. And the reason the paradox exists, this is coming from a guy in the business, not metals business, in the food business. He said, I said, so, why are food prices going up, et cetera, et cetera? And I go, will that come down? He goes, no. He goes, here's what's going on. He said, when food prices go up, there's such demand for things that you need that they're able to pass the price through. The whole eggs thing, all right? So when we raise rates, that just means we buy less color TVs. We still buy eggs. We still pay whatever the price is for eggs. It's basically elastic versus inelastic. So what's happening is every time rates,
I'm having trouble finding egg whites, by the way, but that's just a side comment.
Are you really?
Yeah.
Well, egg prices
able to find
peaked.
egg whites.
Well, you're in Seattle, right?
Right.
Well, maybe they have like different kind of chickens out there.
Yeah. Well, I go to a specialty, type of groceries. That's really good, but for some reason they haven't had any egg whites, or maybe people are just buying them up really fast. I've been able to get eggs though, but not egg whites.
So you have.
But anyway, I'm sorry to interrupt.
No, that's all right. That's a good interruption. It's funny. So I'm the Fed, and let's assume that I'm right, and I know I know the following. Geez, if I keep raising rates, we're going to have to keep spending more and more money on this new fund called BTFP. I forget what the acronym means already, but basically it's a loan program to regional banks so they can have enough money to pay depositors if there's a run. That's what that's about. I mean, there's a lot more going on there, but that's it. And I'm pounding. I go, well, if I lower rates, it's all going to go into the stock market. So I think he's going to hold rates. I think he's going to lower rates eventually, but he doesn't have to lower rates. They're doing rate lowering with sniper rifles. They're giving money to people, right? I mean, that's what they're doing. They're just like
they're essentially, backstopping these banks.
Yeah,
it's kind. I mean, this is not my expertise, but it's kind of a form of QE already. Yes. And so, the balance sheet they already undid. Last week,
right.
Giving all that what they did for these banks, they already reversed half of the tightening in the balance sheet in effect, they've already started easing. And like what you've been saying, when they raise rates anyway, there's going to be easings going on in addition to that.
It's going to be target, right? In fact, that's probably a good thing to bring up. Right now in the whole FinTwit financial gold community, not necessarily gold, but ancillary to gold, we just started QE. We just undid QT. And then there's the other people saying, no, we haven't. And the answer is yes and no. And I'm going to give you the real reason. I looked into this. We haven't stopped QT. QT is unloading bonds off of the balance sheet, literally selling them in there. What we're doing now is we're loaning them money for their bonds as collateral, which in and of itself is bad, but it's not changing QT, it's loans. So the bottom line is we haven't stopped QT, but we have grown the balance sheet. So you want to call it QT? Fine. But the point is, the labels are what everyone's hung up on. The bottom line is they may not be calling it QT, but they just undid 50%, as you just said, of the balance sheet reduction they did in the last 6 months in 1 week. So, and you know what's going to happen. Those loans will be defaulted on a year from now, and they'll be like, okay, we'll forgive you. That's what's going to happen. It has to happen because real estate's going to, commercial real estate, if my friend is right, is going to, exaggerating, is going to zero. Meanwhile, eggs will still be $1 billion for a dozen. So that's what's going on. And people will park their money in gold because of that. I hope they park it in gold stocks. That's where fundamentals come in. And I'm not strong in that area. But anyway, that's it. So the QE, QT versus it's not QE, QT. The federal government's going to tell you it's not ending QT, it's just loaning money. That's true. And then the people that are calling it ending QT are saying, yeah, but you just added all this risk to your balance sheet. Don't tell me that it's not permanent. So basically, it has the same effect as QT ending, but they don't want to call it that. And they have to keep, look, what's going to happen is what's happened in the 70s. They're not going to be able to unload this debt. It's going to be permanent monetization of debt, which is a fancy way of saying we're going to suspend QT eventually and let things roll off naturally. And then we're going to print money and monetize the debt. So the bond market will hold interest rates at, let's say, I don't know, 5, 6, 7%, but the dollar will crap out. And that's it. It's going to happen. You have to put your money in gold. In fact, if you look at the gold market versus TLT, and I think this is important, what you're really looking at is GLD versus TLT. You're really looking at the dollar versus the yuan economically. Our bonds are doing great, but our bonds versus the Chinese demand for gold is doing worse. Anyway, that's it. That's where I am. Hope that helps.
Okay, just two more things, and then I'll let you go because I know you got to eat dinner. You're in the Eastern time zone.
Yeah.
But your comment about gold stocks, because I want to talk more about silver, but it's interesting because I remember Greg Weldon. I don't know if you follow him, but I need to interview him again. But I remember interviewing him. He's a great macro guy. He's a real futures market guy like yourself. And I remember interviewing him right, after, I think it was maybe in April, right after the rebound from COVID was getting going. And I was asking him about gold because gold had a big rebound, but gold stocks had barely moved. And, we were talking about gold stocks and he was saying, oh, well, should be good for gold, but I don't know about gold stocks. But then, gold stocks eventually followed. So I know that there's a lot of, worry or consternation about gold stocks and silver. But if you tell me gold's going to blow through 2,100, the gold stocks and silver will follow. That's my personal opinion. So I'm not worried at all if they're underperforming right now. I mean, the juniors that I look, I have 20 or 25 on my screen, and a good chunk of them had some really strong days, and the rest of them were kind of meh. So I'm not really worried about their underperformance. I think they're really going to get going when gold makes that big breakout. There's fundamental reasons behind that. The margins, potential margins really explode. You get the big breakout. And so, but I want to ask you your thoughts on silver, because those are basically my thoughts. We're kind of in, fundamentally, we're kind of going into a recessionary environment. So gold usually leads, gold should lead. So for me, I'm not that worried about silver lagging or underperforming for a little while. I mean, as long as gold eventually makes that big breakout, I'm not concerned about silver. How are you thinking about silver right now?
That's a good point. I just talked to someone about that today, and they asked me a similar question. First of all, I'm known, for lack of a better word, for telling people in the short term, silver must lead higher. In the short term, silver gets going because it's lighter, it's smaller, it's a contract that's cheaper. So people will spec on that, and then gold will fire. So silver leads in the short term. On the big fundamental macro moves, like we may be starting now, gold must lead. And that's because gold is a safe haven. And so if banks are going bankrupt, you don't start with silver, you start with gold. If inflation is the problem, you don't start with silver, you start gold. If they lower rates, yeah, then you're going to buy silver. So my comment to you is, based on a lot of experience and something I saw the other day that made me kind of friendly. I went, gold should lead. I woke up and gold led. I went, okay, silver's probably down because it's probably like copper. Copper was down and silver was up 1%. And I said, oh, that's good. So silver right now is in transition. I believe, to play it out, to game it out the way you're saying, gold makes new highs, then silver starts to catch up. Silver does not lead this next leg higher. It doesn't, because that's what people want. Silver's economic for the obvious reasons, right? And because of that, it'll be late to the party. It'll have bigger moves. It'll still rally 2% when gold rallies 1%, but overall it'll be late to the party. Yes, you're right. Silver does not have to lead this at all. Correct.
And so just to wrap things up, let's talk about technicals, because we were talking about that early on and I never reacted. For me, I think you were one of your technical guys said a monthly close above 1930, or was it 1940? It was
1940, but I think it was, I had three guys and all of them had between 1930 and 1944. Okay,
great. Yeah, for me, at least what I have been saying in the last week or so, I'm looking at 1950 or 1953 to be exact.
Right.
It's quarterly and monthly resistance, and so that close is coming up. Exactly, so 2 weeks from now. So
it's a monthly close. Is that what it's basically? We haven't closed above that in so long that a monthly close makes it a breakout. Is that how it works?
Yes. I mean, if we're looking at the quarterly charts,
right?
1953, the all-time quarterly closing high is 1953. Now the monthly, I think the monthly all-time closing high is around 2000, but, and so closing this month above 1953, it would be a new all-time high quarterly close. And as far as the monthly close, it'd be the third highest ever. And for me, looking at the weekly candle chart, 1950 to 1970, I think that's where on the weekly chart, like there's some, there's resistance in that area. Right. So I think
maybe they're using
for me, that's
maybe they're using like a non-continuation. I don't know. But I know that.
I'm not spending a ton of time on that. So I would defer to your guys on that. I think they're more.
Screw that. Let's be honest here.
I think they're more keen on that, but I'm just saying from the way I'm looking at the monthly and quarterly charts, for me, if closing above 1953 would be, if we hold these levels in the next, 2 weeks, because it's the close of the quarter, close of the month. If we're trading above 1970 2 weeks from now, I think then we're probably going to see a new all-time high in the short term.
Okay. That makes sense.
I think if we fall back below 1950 2 weeks from today, then maybe we'll correct for a little bit. But nevertheless, I really like where we are, and I think the odds of it looks like we could have not only a really good summer, but maybe a really good spring.
That's right. Really. So that makes sense because I know that on a quarterly basis, they're worried about how gold settles, and that's how funds operate. So if gold settles above 1953, which is your level at the end of the quarter, then it's going to open the door for more allocations of money going into it. That makes complete sense.
And so I'm looking at the weekly candle chart. If we were to close above, let's see, like if we made a weekly close at 1980, that would be the highest weekly close. Basically, it would be the second highest ever weekly. It's the highest weekly close in almost or 2.5 years, basically. So
Right.
I think those are the levels that I would watch. Call it 1980 on the weekly, but again, that monthly close, monthly and quarterly close, 1953. So those are for the very short term, those are the levels I'm looking at. But also, I mentioned earlier this week, gold against foreign currencies making that new all-time high, and then gold against the stock market.
Right.
So I think with where those close today, I think we're going to have a little more momentum. So but like the strength that we saw today, I mean, do you think that was because of the huge move lower in bonds? From a trading aspect, is it some CTAs who were short? Were they covering? Is it a lot of new money coming in? Let's close on that. And today,
okay,
what was driving this move exactly?
When the news came out on Friday, Friday to Monday, when it started to come out, the first buying in gold was everyone was flat in gold. For the 3-week disaster that was gold crapping out when the commitment of traders was unavailable, that was the funds getting out. They all got out. And on the lows, nobody was short gold that mattered. Nobody was long gold that mattered. And that's why silver had that 6% up day. Because the shorts were in small shorts, the CTA types, they were in silver. The gold guys didn't buy. So after the first 2 days of runs, now you're getting fund business get very long. I think because of the type of news that you're going to see bigger allocations to gold than you have in the past. And that's because it's banking and inflation. That's because everyone has the memory of when the war started. And that's because no one sold, and I brought that up for a reason. When gold was on the lows, the funds weren't short gold. Usually they get short gold on the lows. They weren't really that short. And that's a sign of a market that wants to get long. Sometimes it's a sign that the market needs to be oversold, like in silver, but gold's not like that anymore. So to answer, the reason I bring that up is because inevitably there will be a wave of selling, just like there was when we crapped out last month when the commitment of traders reports mysteriously disappeared. And that will be profit taking by longs getting out. That won't be players getting short. Nobody's short in this market anymore. There is only one natural seller out there. Miners aren't selling, bullion banks aren't selling, and that natural seller is Russia and company. Russia, Kazakhstan. I fully expect, Jordan, big selling to come out of the BRICS from this. Right now, they're probably selling at the strength, no doubt. And the funds are getting long. So if we're in like one of those Elliott wave type of things, we're going to start, having volatility to the upside and downside. 2 steps forward, 1 step back type stuff. So until the banking crisis is stopped, I'm buying dips. And I think the banking crisis, frankly, the banking crisis is stopped. They've stopped it. What they're worried about now is public perception. And they can't stop public perception, which is like, oh no, my bank's, the people are, they're not that bright. They're going to be like, okay, the banks aren't going to go under. You're not going to lose your money. What's going to happen is they're going to print more money. And so that's where the cure for default is inflation. And we are now at the cure for default. And so therefore, the cure is inflation, whether it be lowering rates, which is what you believe, and I believe too, or just be a lot of handouts, which are going on right now, which are probably necessary. Anyway, they can't stop the change in sentiment of people in these markets now. And JP Morgan brought over I don't know how many tons. The GLD contract is going to be a bigger contract. It's not going to go away. It's not going to default. They can't afford to let it. So long story short, I'm buying dips as long as there's no news. Gold will drop on news now. Any drop that's not on news, I'll buy dips. That's basically it.
Yeah, you were talking about the BTFP before, and so for gold, it's BTFD. Is that buy the fucking dip? Is that?
Well, yeah,
BTFD?
it was yeah, it used to be BTD, buy the dip. Then it became buy the fucking dip during QE, and now it's BTFP. I forget what it stands for, but it has to do with
some banking thing, right?
yeah, it's banking. But the last word is, but everyone's calling it now buy the fucking pivot. You know, so everyone is in your court saying the pivot's going to happen, and it's probably going to happen. So buy the fucking pivot is why gold went up. That's why stocks just strong as gold.
But just to finish on this, I don't want to belabor but like even if they, let's say they raised a quarter point next week and they said, oh, we're still going to work on, I mean, I don't even think it's that bearish for gold aside from, positioning or the market. Because the perception in the people, they know what's coming. They know the market's already discounting rate cuts this year. They know the economy is going to, this is like the market getting what we were talking about at the beginning, the market meaning, buyers, sellers, people, consumers, et cetera.
Right.
Everyone is sniffing out what is coming. They don't need they know the Fed is going to have to do whatever they do. It's going to be gold favorable.
Right. Okay. So Zero Hedge threw a tweet out there today that made me think of what you just said. And basically, the Fed is taking the stance today, right now, that we're going to raise 25 basis points. We're going to raise 25 basis points. And Zero Hedge made a snarky comment like, let's see what the market says about that. Something like that. And their point really is simply this. If the Fed raises 25 basis points, stocks will crap out. Bonds will crap out. Banks will go under. And gold will probably get hit initially. And then gold will be bought. And you know who gold's being bought by when that happens? The banks themselves are buying.
Yeah, I was going to say, yeah.
The bond traders themselves are buying gold because that's what gold is. Gold is money, and money is traded in bonds, and that's what banks are doing. And so if the Fed raises 25 basis points, expect stocks to, here's what's going to happen, right? They're going to raise 25 basis points. Stocks are going to drop. Bonds are going to drop. The yield curve is going to kind of get all messed up again. Gold's going to drop. And then someone's going to go, wait a minute. If they're raising 25 basis points here, then they're going to be rescuing another bank there. And that's what's going to happen. And when that happens, you're going to see gold go back up. So it used to be QE, money's being printed, buy stocks, then buy gold. Now it's going to be QT is ending, buy gold, then buy stocks. So yeah, there's not much they can do to hurt gold right now, unless they go after gold itself, which they can't admit that they're doing, even though they do it.
Well, on that note, Vince, thanks so much for everything today. Really enjoyed it. Really informative. Before I let you go, can you tell all our listeners how they can follow you on Twitter, where they can get the Gold Fix, how they can subscribe?
Sure. The Gold Fix is VBL Gold Fix or goldfix.substack.com. I gave you a link before. I'll refresh it if I have to, but your listeners can get 30% off now, and I have no problem with that. The other thing I wanted to mention is I was on someone else's program, and when the market does what it's doing these last 7 days or so, I put out some special notes to people, and I get some really good bank reports as well. And I would say this to you genuinely in a public service way. Sign up if you want to. Sign up for the premium for a week for free. It won't take money until the 7th day. Cancel on the 2nd day if you don't like it. What I'm getting at is people like what I wrote the last 3 days summarizing what happened in the banks. And if you could just read that and cheat and just do that, that's how I feel about it. Anyway, on Twitter, I'm VBL's Ghost, Soren the K, but that's basically it. I'm telling you what I told someone else. Like, you know what? sign up and take the free week. If you don't like it, just remember to cancel it. That's it. So, because with everything that's going on, there are only really 3 sources out there that are putting out information that's helpful. And Zero Hedge is putting out the information that'll give you the actionable. This is going to happen tomorrow, do that, right? And I'm giving people the overview of what's likely to happen if it doesn't work. So, and there's other people out there talking as well. That's all. I just think I say this, it sounds like I say it because I mean it, just cancel it if you don't like it. I think you're gonna be happy. That's it.
Well, yeah, I think so too. And I'll give you a plug. It's really outstanding. I mean, you do a thorough job on, everything that's driving the market, sentiment, positioning, technicals, fundamentals, while taking in and sharing these reports from, be it Bank of America, Merrill Lynch, Zero Hedge, all those things. So it's one of the, if there's only one thing you want to read every morning for precious metals, it would be this thing. And that's why I read it myself. So on that note, we'll get that link out to our listeners. Vince, I appreciate it so much. And hopefully we can do this again the next couple of weeks.
Thanks, Stuart. I really appreciate it. And it's a shame that the talk that we had before we started recording isn't going to be aired, because your audience should know that the conversations about mob movies and about sports teams are probably better than the conversations about gold. Sorry, it's just true. They're that much fun. Anyway, thanks again.
Well, I am thinking of starting a podcast so we can, publish those separately. But
Dude, absolutely.
Thanks for that plug as well.
Yeah, you should.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.